China is definitely making a move to make gold exchangeable for yuan by opening vaults outside China. SGE vaults are being opened in Hong Kong and also in Saudi Arabia, and there will be facilities in other Southeast Asian nations. So the whole of the BRICS cohort, as it were, will be looking at a situation where, for trade purposes anyway, the yuan and gold will be exchangeable, and presumably at some stage in the future there will be a fixed exchange rate. So if you're an African central bank, it does make sense that you've got to start accumulating a bit of gold. I can see that central bank demand for gold is probably going to accelerate.
It starts with a small detail most people missed: the sudden disappearance of leased gold from the London market earlier this year. That single event sent a shock through central banks, because leased gold is the quiet backbone of the entire forward market. When those ounces were pulled back, it exposed how dependent London's pricing system is on central banks being willing to part with their reserves. Many of them took one look at the volatility and decided they're not doing that anymore. Once that lending dries up, liquidity in the forward market thins out. And when liquidity thins out, the bullion banks lose the ability to manage price the way they've been doing for decades. Macleod's point is that the big institutions aren't stupid. They see where this is heading. That's why the same Wall Street firms that spent years dismissing gold as outdated suddenly sound comfortable telling clients to allocate real weight to it. They're preparing for the new landscape rather than fighting it. Step back and the pattern gets clearer. Less leased gold. Less speculative trading. More strategic, long-horizon buying. And alongside all of that, China has been building its own settlement plumbing, gold vaults in Hong Kong and Riyadh, gold for yuan trade channels across Asia and the BRICS sphere, and a framework that lets governments settle commodity flows through a silent gold anchor behind the yuan. This isn't a public gold standard or a redemption system for citizens. It's a state-to-state settlement layer designed to stay operational if the dollar-based system wobbles. Quiet, methodical, and already functioning. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
If you look at the open interest in COMEX at the moment, just to take futures market, it's sort of not that high. I mean, it's sort of average to slightly less than average, which suggests that the amount of speculation, the amount of if you like, momentum trading, speculative trading, and so on and so forth in the futures market is actually not all that great. So, the idea that they could sort of maybe bash it down and really shake the trees, as it were, get out to all the loose holders, that doesn't really apply in this situation. So it is a fundamentally different situation. And of course, the other thing is that I think this is a topic you might like to follow up on. China is definitely making a move to make gold exchangeable for yuan by opening vaults outside China. SGE vaults are being opened in Hong Kong and also in Saudi Arabia, and there will be facilities in other Southeast Asian nations. So the whole of the BRICS cohort, as it were, will be looking at a situation where, for trade purposes anyway, the yuan and gold will be exchangeable, and presumably at some stage in the future there will be a fixed exchange rate. So if you're an African central bank, it does make sense that you've got to start accumulating a bit of gold. If you've got mines in your territory which produce it, you'll hang on to it, which will leave the market short. If, on the other hand, you haven't, then you've got to go into the market and try and get some. So I can see that central bank demand for gold is probably going to accelerate. And the other side of it is that following the debacle earlier this year, when the Bank of England had a rush on its vaulted stocks, I think the central banks who saw their leased gold walking out of the door will think, I don't think we really want to do this in future. So I think you'll find that gold leases, which are essential for the liquidity of the forward market in London, I think the availability of those leases is going to diminish. I suspect it's already diminishing. And I think that the bullion banks are already aware of this, which is why they're quite happy to talk the price of gold up now, just as the major banks are. You get Morgan Stanley and so on now openly talking about higher gold prices and talking about, well, you should have 20% in gold, I think in the case of Morgan Stanley. Things have changed hugely, but it's just that, when the equity bubble pops, there's going to be a lot of widespread fallout in all sorts of different things which are not directly related. The Bank of China is now extending facilities outside China whereby yuan can be exchanged for gold. That's the whole point about the new SGE vaults, which are being opened outside China. I mean, they are exclusively for the exchange of gold for yuan and vice versa. So that, I think, is a very clear signal that in the future, trade settlement on a national basis, if you like, what it's called international, between nations, will be on a yuan which is tied to gold. And it looks to me as if it's going to be, if you like, a modified version of Bretton Woods, where Chinese nationals or indeed nationals in a BRIC nation can't sort of go along to a bank and say, I want to change these yuan for gold or whatever at the exchange rate. I think it will be just available at the international level between nations. That's the whole thing. It'll be for trade settlement. That is absolutely clear. If you can't see it, then, you wake up, for goodness sake. It's all there in front of us.
Macleod lays out a cycle that's almost mechanical once it starts. When the US's massive financial bubble finally gives way, everything that's been held together by cheap money unravels fast. Stocks crack, margin calls kick in, leveraged players dump whatever they can, and liquidity dries up across the board. Banks pull back because they're terrified of counterparty risk. Companies that relied on rolling debt suddenly face higher refinancing costs at the worst possible moment. The slowdown jumps from Wall Street to the real economy in a straight line. And when that begins, Washington doesn't have a menu of creative solutions. It has one lever: inject liquidity. The Fed has already shown its hand. They talked tough on inflation, but the moment markets started wobbling, their focus shifted to stability. That pivot is the tell. When things break, they'll print, not with fanfare, but through backstops, facilities, and emergency buying programs that quietly expand the money supply. Macleod argues that the real pressure point isn't the Fed funds rate but long-term bond yields. If investors think the dollar is about to be diluted again, they won't lend for a decade at 4.5%. They'll demand more to compensate for currency erosion. Higher yields then hit the economy while it's already weak, pushing the dollar down even faster. Let's get back to the interview.
All the members of BRICS, who on the one hand are terrified of, having their dollar loans called in by the Americans or regime change forced upon them. I mean, this has been the history, if you like, of American imperialism. They're really quite careful in what they're doing, walking a bit of a tightrope on this one. But they can see which way this is going, and it does encourage them, I think, to get trade settlement arrangements in place, hence signing up for the Chinese, exchange trade settlement system. They've rather got to do that. And I think very, very quietly they're doing it, and very quietly they're looking to beef up their gold reserves as well, because they will need them in this new world. I mean, what we're looking at is a post-fiat currency world. It's not just me who's been saying it. It's, I think, some of the smarter heads, if you like, in central banks. They know what's going on. They may not be able to do anything about it, and they also follow policies which they know to be wrong. But these guys aren't stupid. They understand the difference between money and credit. And consequently, they're going to protect themselves against a complete collapse of the fiat currency system, which is what we are moving towards. And you can see how that's going to happen too, because when this equity, or if you like, the financial asset bubble pops, and this is particularly the case in America, then you're going to get collapsing stock markets. You're going to get collateral problems, which I've just described, through all the margin loans being foreclosed on and all the rest of it, which will increase the selling into a falling market. And at the same time, you're going to see businesses faced with higher refinancing costs, banks reluctant to lend anything into the private sector. So, this is going to, if you like, hit the non-financial private sector very, very hard in terms of cash flows and all the rest of it. Consequently, we go into a slump. Now, what does the US government do under those circumstances? Well, the answer is quite simple. It stands there to rescue everything and to stop a slump happening, and indeed, if possible, to stop even the stock market sliding. How do they do that? By debasing the currency. They debase the currency not by suddenly announcing a new rate of exchange to gold. What they do is they just print, and they're already doing this. This is the whole point about the Fed changing tack from worrying about inflation to saying, okay, stop QT, start QE, interest rates are secondary. But the point is we've got to get liquidity into the system to stop it falling over. That was what the Fed was doing. I mean, it was a very clear signal to all of us where the priorities now lie. I mean, one of the things that's been sort of undermining sentiment in the market a bit is we were absolutely certain that we were going to get another cut in the Fed funds rate in December. Now it's 50-50. So you can see that there are doubts creeping in, if you like. But the interest rate scene isn't so important. What really matters is what the bond yields do. And what the bond yields will do is they will start discounting the growing certainty that there's another round of dollar debasement about to occur. I mean, when you get dollar debasement, what sort of level are you going to demand in terms of return to part with your dollars, say, on a 10-year basis? Is 4.5% enough? Probably not. That's the problem. You're going to have rising borrowing costs against an economy which is suffering from the fallout of, if you like, an equity bubble implosion. And it'll destroy the currency. It is as simple as that.
What's emerging now is a landscape that doesn't behave like the old one, no matter how hard policymakers and market makers try to pretend otherwise. With leased gold retreating from London, an entire pricing architecture that relied on those invisible balances is losing its scaffolding. Trading desks that once moved comfortably through the forward market are suddenly acknowledging that the metal they treated as interchangeable paper is no longer as freely available as it once seemed. At the same time, long-cycle buyers, the kind who don't chase headlines, are stepping in and reinforcing a shift toward ownership rather than speculation. Layer that against the slow, deliberate construction of alternative settlement channels across Asia, where gold sits quietly behind commodity flows as a stabilizing weight, and the transition becomes harder to ignore. With the mechanics of the old framework weakening and new settlement structures steadily gaining ground, the real puzzle now is whether the next major shift in the global financial order will be triggered by market stress, by policy decisions, or by the quiet realignment already unfolding beneath the surface. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.